This week, we talk about market efficiency. Market efficiency is a very important topic, which is somewhat subtle. Part of the challenge is that the notion of efficiency is broadly used, and it has different meaning in different contexts. In our discussion in finance, efficiency has a very particular precise meaning, which we are going to clarify. The general notion of economic efficiency has to do with the allocation of limited resources. Are resources used in the most productive manner possible? It is certainly an important question, and a well-functioning financial system plays a critical role in allocation of resources. This is not, however, how we think about efficiency in financial markets. Financial market efficiency is about how well market prices aggregate information. In an efficient market, prices fully reflect all available information. What we are going to do is clarify what exactly it means for prices to fully reflect information. We will also look at empirical evidence in favor or against the efficient markets hypothesis. Why would we expect markets to be efficient? The answer is ultimately because of arbitrage. Financial markets are fiercely competitive. Traders, by chasing profitable trading opportunities, incorporate all useful information into prices. As a result, prices fully reflect all relevant available information. A common criticism that you would hear is that how can markets be efficient when investors are human and humans make mistakes? That is certainly true. However, this criticism is misplaced. Market efficiency does not require most of the traders or investors to be rational and well-informed. What we need is just a few smart, well-financed agents who are unconstrained, and they are the ones who can spot and eliminate profitable trading opportunities. They eliminate inefficiencies. In other words, market efficiency is a theory of sharks who capture profitable trading opportunities. It is not a theory of how an average investor behaves. We will now discuss a particular example that illustrates the notion of market efficiency very well. This is the Challenger crash. It happened in January of 1986. On the 28th of January at 11:39 a.m., the space shuttle Challenger exploded. It was 73 seconds into its flight. Immediately, news outlets reported the event. Space shuttle explodes. Various contractors who contributed parts of the shuttle were asked to comment. They had no immediate comment. A presidential commission was formed to investigate the causes of the crash. Famously, Richard Feynman, a well-known physicist of the day, was on the commission. The commission eventually concluded, several months later, that the cause of the crash was the infamous O-ring. In the report published on June 9th of 1986, the commission found that this rubbery piece of insulation failed due to low temperatures, which led to fuel leak and ultimately the explosion. Let's take a look at the action in the financial markets on the day of the crash. We're now taking a close minute-by-minute look at the price behavior. What you see on the graph is a time series of prices on several companies, which were the important contractors contributing elements of the shuttle. In the first few minutes, immediately following the crash, all of these prices collapsed. At that point, the market did not know which of the contractors was responsible, but it was clear that someone will be at fault, and the news was bad. A couple hours later, we see a divergence. All of the prices, except for one, start recovering. But one of the stocks does not recover by the end of the day. This stock is the stock of Morton Thiokol, which was the producer of the O-ring. How did the market know almost immediately who was at fault when it took several months for the Presidential Commission to figure it out? The answer is that some of the engineers at Morton Thiokol knew that there was a potential problem with their O-ring. They tried to warn NASA about the danger, but they were ignored or overruled. The lesson here is that information that is available to just a few can get impacted into prices relatively quickly. This is how markets reach efficiency. They're very good at aggregating useful pieces of information. We now need to introduce a testable definition of what it means for prices to fully reflect all available information. According to our definition, a market is efficient if it is impossible to make excess profits by trading on all available information. Formally, what it means is that the expected value of the price plus the dividend next period, conditional on all available information, which we denote by the information set J sub t, is equal to the current price times the conditional expected return on the asset. The exact form of market efficiency depends on what exactly we include into the information set. What do we mean by all available information? This is captured by J. There are three important cases of market efficiency, three forms. The weak form specifies that all available information means all of the information included in the past history of security prices. For example, if the market is weak form efficient, it means that technical analysis, which looks at the past history of prices, cannot be used to achieve excess returns. The next level of market efficiency is what is called the semi-strong form efficiency. Under this notion, security prices reflect all publicly available information. This is not just information on prices, but also information from other public sources. Under the semi-strong form of market efficiency, fundamental analysis that looks at various kinds of fundamental data does not allow one to achieve excess returns. Finally, we get to the strong form of market efficiency. As the name suggests, this is the strongest notion, and according to the strong form, all information is reflected in prices, both public and private. Under this hypothesis, inside information available to the firm insiders does not allow them to achieve superior performance or excess returns. When we test the efficient market hypothesis empirically, it is critical to differentiate excess or abnormal profits from the risk premium. This means that to make the efficient market hypothesis usable, we need to take a stand on a particular risk model. We need to identify what is the risk premium justified by the risk exposures of the assets and what part of their excess returns is abnormal, which would be a violation of the efficient markets hypothesis. There are two common approaches of dealing with this challenge. We could use a common set of risk models to perform a risk adjustment and to identify what part of returns is abnormal on a risk-adjusted basis. The difficulty is that we do not have a well-accepted common set of risk models, and therefore there is always a lingering doubt that what we are seeing is not an abnormal performance, but rather a failure to find the right risk model. The second approach would be to find a profitable trading strategy that would be very difficult to justify by any risk model. And we're going to look at some of the examples of such strategies. Obviously, testing the efficient market hypothesis looks at a composite hypothesis. The markets are efficient and that our risk adjustment is correct. We're going to keep this in mind when we examine empirical evidence. We now examine the weak form of the efficient markets hypothesis. Empirical tests of the weak form look at various patterns in returns. Patterns such as serial correlation in returns, or performance of filter rules, or performance of technical analysis. Let's begin with the serial correlation. If past prices could be used to predict future returns, we would be able to detect a correlation between price changes and successive future returns. In other words, we would be able to see statistical correlation between past returns and future returns. This is known as serial correlation. Would high degree of serial correlation be inconsistent with the efficient markets hypothesis, or could it be explained by a risk model? The challenge when trying to explain serial correlation with the risk model is that one would need to argue that the conditional risk of an asset changes rapidly over time in relation to past returns. Most common risk models do not have that property, at least not at the high frequency, such as daily. In the following graph, we see an illustration. We look at daily returns on two stocks. One is Philips Electronics, the other one is Sony. These are both scatter plots. On the horizontal axis, we plot daily returns on day T, and on the vertical axis, daily returns on the consecutive trading day, T+1. Both of these scatter plots reveal no obvious pattern. They look like a ball of points. This is the point here. There is no pattern of serial correlation in the daily returns of these stocks. As we estimate the serial correlation statistically, we see that it is very close and indistinguishable from zero. This type of pattern is typical. For most individual stocks, serial correlation of returns is very close to zero. In a well-known study in 1965, Gene Fama analyzed patterns of serial correlation across various stocks, and he found that at the horizons of 1, 4, 9, 16 days, evidence for serial correlation is essentially absent. On average, serial correlation among consecutive stock returns is very close to zero across stocks. The same can be said about index returns or portfolio returns. The following graph illustrates lack of serial correlation for the S&P 500 index. Looking at the 10-year daily sample, we see that the relation between daily returns on consecutive trading days reveals no obvious pattern of serial correlation. There are other statistical patterns that one can explore which are related to the weak form of market efficiency. Two famous results are on momentum and reversal in returns. In a 1993 paper, Jagadish and Titman documented presence of medium horizon momentum in asset returns. What they did is they sorted stocks on their past returns over, say, a 6-month interval, and then documented their average performance over the following 6-month period. They found that the past winners tend to outperform over the following period. The past losers tend to underperform. This phenomenon is known as momentum. Strong returns tend to continue, and weak returns tend to continue at certain horizons of several months. Hong, Lim, and Stein found that momentum is particularly strong among small stocks with low analyst coverage. A different pattern, called long-term reversal, was documented by DeBond and Thaler in a 1985 paper. They found evidence that losers over longer horizons, let's say 36 months, subsequently outperform over the horizon of 36 months. It's the opposite for the winners. Past winners tend to underperform over a similar horizon. The following graph shows some empirical evidence for the historical performance of the past winners versus past losers. What we see is a clear difference in the average returns, the winner portfolio outperforming the loser portfolio. As we look at the historical performance of the momentum and reversal strategies, the question that arises is, do these pose a challenge to the weak form of the efficient markets hypothesis? Can we explain differences in performance between winners and losers by differences in risk? This is a subject of an ongoing debate. For example, is it the case that the past winners are more risky than the past losers? Is it the case that the long-term losers in the reversal strategy become more risky as a result? When we compute abnormal returns, we need to know what the normal returns are, returns justified by the risk exposure. Part of the challenge with the momentum strategy in particular is that membership in the winner and loser portfolios changes over time. Past winners don't stay in the winner portfolio for long. The same is true for the past losers. This means that if we wanted to explain momentum based on risk exposures, we would have to argue that the risk of stocks changes at a relatively high frequency over time. Momentum strategies are also fairly well known, and they're commonly used by investment managers. The fact that their profitability does not tend to disappear over time suggests that these returns may not be purely abnormal and may indicate some kind of risk exposure. And that is the reason why they don't get arbitraged away. We now consider the semi-strong form of market efficiency. Under the semi-strong form of efficiency, all public information should be fully reflected in prices, and it should be impossible to achieve abnormal risk-adjusted returns by trading on public information. This implies in particular that fundamental analysis should not be useful for achieving abnormal investment performance. Now, the purpose of fundamental analysis is to exploit opportunities when some public information about firms is not reflected in prices immediately. If markets are semi-strong form efficient, fundamental analysis is not going to achieve that goal. Information included under the semi-strong form of market efficiency is going to contain things like firm financial statements, any types of corporate announcements, such as news about earnings, dividends, share repurchases, debt issues, stock splits, and so forth, as well as mergers, acquisitions, and takeovers. None of these types of announcements, none of these sources of public information should be useful for generating abnormal investment performance. Let's examine how prices should respond to information under the semi-strong form of market efficiency. When the news arrives, there are three possible patterns. The price may react to the news immediately with no further adjustment. This is the blue line on the graph. We may see delayed reaction, which is the dotted line, so that information gets priced in eventually but not immediately. Or we may see overreaction, where the price moves too much in response to an information release, and then it recovers back to the appropriate level. Under the semi-strong form of market efficiency, price reaction to news should be immediate, and we should not see any underreaction or overreaction. There should be no predictability in returns following the announcement. In other words, the blue line in the graph represents the average pattern of price response to the news. As we examine empirical evidence, we are going to look for evidence in favor or against this type of price response to information. An important tool used to analyze semi-strong form of market efficiency is event studies. The objective of event studies is to examine if firm-specific information is incorporated into the price in a single jump once information is released. Let's discuss the design of the event studies, which is a commonly used statistical setting, and it's applied broadly, not just for the purposes of analyzing market efficiency. The idea is to pull together various observations and to connect them in time so that date 0 corresponds to the date at which information is released. The actual events, of course, are going to occur to various firms at different points in physical time. We then calculate daily returns during a window, let's say a 30 days window, around the announcement date, around date 0. We look 30 days prior to the announcement and 30 days following the announcement. We then define the comparison group. For example, we could look at the market portfolio or the industry portfolio or a portfolio of similar firms as a comparison group. And we compute returns on the comparison group on the same days. We denote the return on the market or a different kind of comparison group as Rm sub t for each day t. Next, we define the abnormal return. The abnormal return is the difference between the return on the stock on day t and the return on its comparison group which is supposed to have the same risk profile. The abnormal return, AR, on stock I at day t is the difference, R sub IT minus RMT. In other words, it's the return on the stock minus the benchmark or the comparison group return. Once we define the abnormal daily returns on the stock, we calculate the average abnormal return over all of the events. This is defined for each day in our window, 30 days prior to the announcement to 30 days following the announcement. Finally, we define the cumulative abnormal return, starting from 30 days prior to the announcement and all the way to the end of the window, 30 days afterwards, and the cumulative abnormal return is computed by simply adding up abnormal returns on consecutive days. This cumulative abnormal return is our object of analysis. Under the semestron form of market efficiency, we should not see, on average, a positive cumulative abnormal return. If you look at the following graph, we see again an illustration of how the cumulative average abnormal return should look under the efficient reaction to information, under underreaction and overreaction. Following the efficient reaction to information, we should see an immediate jump on announcement on day 0 with no clear pattern up or down following the announcement. If, on the other hand, the market underreacts to information, we should see that the immediate response is relatively muted, and there is a pattern of predictability with the upward drift in prices following the announcement. If the market overreacts, we are going to see a very large immediate response and then mean reversion afterwards. It is clear that under the efficient reaction to information, we will not be able to generate abnormal profits by trading on public information after the announcement. If the market under or overreacts to information, then such strategies will be possible. If the market underreacts, buying following the announcement should lead to abnormal profits. If the market overreacts, we want to sell following the announcement, and that again would lead to abnormal profits. Let's examine some empirical evidence using the event study tool. We are going to look at a couple of different types of corporate announcements. One is the takeover announcement. When the firm becomes a target of takeover, it receives a takeover offer which is typically at a significant premium to the current price of the firm. Following the takeover announcement, the price of the target firm jumps, but not all the way to the offer price. This does not necessarily create a profitable trading opportunity. The reason for that is that following the news of the takeover offer, there is still significant uncertainty about whether or not the takeover is going to go through. The question we want to address is whether it is possible to generate abnormal trading profits by buying the stock of the target firm following the takeover news. As we see in the following graph, when we look at all of the firms following the announcement of the takeover offer, there is no obvious pattern in the stock price behavior following the announcement. The stock price jumps on the news and remains flat on average over a 60-day period following the announcement. If we then look at all of the firms for which the takeover eventually materializes, their price tends to move higher over the 60-day window. Of course, we cannot monetize this type of pattern because we don't know in advance which of the firms are going to eventually complete the takeover. If we look at the firms for which takeover does not go through, the price of these firms reverts to the pre-offer level. Again, this is looking at the data with the benefit of hindsight. We don't know at date 0 which of the firms are going to end up on the blue or the yellow lines. What we see instead is the average pattern across all of the firms. And when we look across all of the firms, there is no predictable price reaction following the announcement. In other words, markets seem to respond to the information about a takeover offer in an efficient manner as predicted by the efficient markets hypothesis. The response is immediate, and there is no subsequent price drift. Another type of news that we examine using a similar design is the announcement of dividend emissions. Typically, when the firm decides to emit a dividend, that is perceived by the market as a piece of bad news. Firms are highly reluctant to cut or emit dividends, and they only do this when their business circumstances require so. In other words, the news of a dividend emission is bad news about the future prospects of the firm, and in particular, it's a negative signal about future cash flows. What we see empirically is that the price tends to drop on the announcement of the dividend emission, which reflects the fact that this is a piece of negative news about the future cash flows of the firm, and there is no clear pattern of price drift up or down following the announcement. Again, what we see is that price behavior around dividend emissions is consistent with the semi-strong form of market efficiency. Price responds to the announcement immediately, and there is no room for achieving abnormal trading profits by trading following the announcement. Next, we look at the pattern which is known as the post-earnings announcement drift. Our discussion is based on the paper by Bernard and Thomas from 1989 that looked at the price behavior following earnings announcements. This pattern poses a bit of a challenge to the semi-strong form of market efficiency. If we sort stocks into portfolios based on the magnitude of the surprise in their earnings announcements, in other words, if we look at earnings announcements in relation to analyst expectations, we find that the stocks for which earnings announcements deliver the largest positive surprise relative to expectations tend to jump on announcement, which is what we would expect, but then what is puzzling is that they continue rising in value following the announcement. If we look at the other side, if we look at the stocks with a negative surprise, we see the reverse pattern. They fall in value on announcement and then continue declining afterwards. This pattern is puzzling, and it is similar to the momentum pattern. Companies that perform well during a recent window continue performing abnormally well going forward, and firms that perform relatively poorly, looking back, continue underperforming going forward. To explain this pattern, using a risk-based model, we would need to argue that the firms that deliver a positive earnings surprise have a relatively high level of risk going forward, and this is what explains their relatively high performance. The firms that have a negative earnings surprise would need to have a relatively low level of risk, which would explain why their average returns going forward are relatively low. It is fairly challenging to come up with a plausible risk-based explanation for the post-earnings announcement drift. It is fair to say that there is no consensus on whether or not this pattern is an anomaly or evidence of time-varying risk exposures of the firms. The challenge in testing the semi-strong form of market efficiency is that we can only hope to find evidence against the hypothesis. To do that, we would have to find a trading strategy using public information that achieves abnormal returns. We cannot examine all possible trading strategies of this type. Therefore, there is always this lingering doubt that perhaps we simply didn't look at the right types of trading strategies, and that is why we haven't identified abnormal returns. There is an alternative strategy for testing the hypothesis. Instead of looking for particular trading strategies, particular types of public information to predict returns, we are going to look instead at asset management and ask whether or not active asset managers are able to achieve abnormal returns. The idea here is simple. Active asset managers use fundamental analysis, they use public information to try and achieve abnormal performance relative to their risk-adjusted, risk-matched benchmarks. We're going to look for abnormal performance of such managers and if they are able to beat their benchmarks on a risk-adjusted basis, we're going to conclude that there is evidence that some types of public information is useful for generating abnormal performance. We wouldn't know exactly which signals these managers are using, but we're going to see that somehow they're able to use public information to achieve abnormal returns. If, on the other hand, active managers are not able to outperform on a risk-adjusted basis, we are going to conclude that all sorts of public information that these managers may be looking at are not useful for achieving abnormal performance. This is the idea. Instead of looking for signals based on public information ourselves, we are going to examine performance of the active asset managers and see if they are able to use public information to achieve abnormal investment performance. We're going to look at the active equity funds and compare their performance to equity indices. This is a somewhat crude way of adjusting for risk by comparing a return on a mutual fund to the broad market return. We find that, on average, mutual funds tend to underperform the market, about 60–70% of the time. One may argue that perhaps the appropriate way of doing risk adjustment is not to simply subtract the market return from the fund return, but to estimate the risk exposure of the fund and to risk adjust each fund based on their particular risk exposure, which may not be equivalent to the risk in the index. This type of refinement does not change the conclusion. The majority of the funds does not deliver abnormal returns on a risk-adjusted basis. This type of risk adjustment also includes adjustment for expenses, asset management fees. Any type of abnormal performance that the managers may be able to achieve by using public information is erased by expenses. At the end of the day, the professional investment management doesn't seem to generate value for investors, and any type of value added they seem to be able to produce using public information accrues to the managers themselves and not to the investors. The following table summarizes historical performance of all equity funds grouped along a number of dimensions. We can see that when we look across all domestic equity funds, or when we group them by style, by size, and so forth, the pattern is very similar. The majority of the funds underperforms their benchmarks, particularly over longer periods of time. The advantage of this type of analysis is that instead of comparing all of the funds to the broad market, we're comparing them to the benchmark that the funds themselves state as relevant for their investment style. The hope is that this kind of comparison captures the risk exposure of the funds relatively closely. Another way of looking at the evidence is to ask whether there is any way to predict which funds may outperform their benchmarks or the market going forward. Perhaps, on average, funds do not deliver abnormal performance, but could it be that some of them are able to do so? And if we simply focus on the best funds, we will see evidence of abnormal investment performance using public information. It turns out that it is very difficult to identify or predict which managers are going to outperform going forward. In the following table, you see one type of analysis that provides evidence of the lack of predictability in investment performance. This is a very simple approach. We sort funds on their past performance into 5 quintiles, from the 20% of the worst performers to the 20% of the best performers, and then examine how these funds do going forward. What we see is that past performance does not predict which funds will end up as future winners, specifically which funds will be in the top quintile by investment performance. The only pattern we see is that poorly performing funds, the funds in the bottom quintile of past performance, are likely to perform somewhat poorly going forward, and are also more likely to end up closed or to merge with another fund. Because these mutual funds cannot be shorted, such pattern of predictable poor performance cannot be used by investors to generate abnormal positive returns. One may argue that the reason why we do not see a pattern of predictability in returns, why we cannot identify the winner funds, the best managers, is because our method of analysis is relatively crude. Perhaps sorting funds on their past performance is not the best way to find the best managers, and there is a more sophisticated approach that could reveal funds with a relatively high positive abnormal performance. One idea for addressing this type of challenge is to look at the professional pension fund managers. Instead of looking for the winning mutual fund managers ourselves, we're going to look at the performance of the pension fund managers who try to identify the best mutual fund managers for managing their assets. Our discussion is based on the academic studies that looked at the sample of pension fund managers from the 1994 to 2003 period and examined their hiring decisions for mutual fund managers. In this sample, we see over 8,000 hiring decisions of 3,400 plan sponsors. These are pension funds that allocate their capital to professional money managers. What we observe is that prior to the hiring decision, performance of the fund managers is relatively good. They outperform their benchmarks on a risk-adjusted basis by several percentage points. This is not surprising because plan sponsors use past performance of the fund as an input into their decision. What we see after the hiring process is that going forward, these managers tend to outperform their benchmark by approximately 64 basis points. This is on a value-weighted basis. This amount of outperformance is consistent with the typical level of management fees that these funds charge. In other words, following the hiring decision, these managers do not deliver abnormal performance after fees. Any kind of outperformance they seem to be able to generate is then consumed by the fees that they charge to the plan sponsor. In conclusion, what we see is that it is not easy to find trading signals based on the public information that would allow us to forecast future returns. While academic literature contains some examples of the signals that seem to forecast returns, one has to be careful interpreting this kind of evidence. It seems that while it may be possible to find such signals in historical analysis, we do not see evidence of abnormal life performance of the professional managers. The challenge of going from the academic results, from the backtests, looking for abnormal patterns in returns, to the actual investment strategies is that when we implement trading strategies, we have to deal with a variety of frictions that eat into performance. Trading costs, market impact, constraints, and so forth, as well as various statistical biases. At the end of the day, any evidence that we may find by analyzing historical data doesn't seem to translate into actual investment performance of professional active managers. We now examine the strong form of market efficiency. This is the most extreme form of the hypothesis, and it states that no information can be used to achieve abnormal investment performance, not even private information. Most academics and practitioners believe that this strong form of market hypothesis does not hold in the data. Markets are not strong form efficient. Private information could be used to achieve abnormal returns. We're going to look at some academic studies that examine performance of insiders and find evidence of superior returns based on private information. We should know that in most developed countries, trading on insider information is illegal. In the US, legislation from 1934, the Act of the US Securities and Exchange Commission, rules against insider trading. trading by firm insiders based on private or privileged information is prohibited. There are also constraints on the investment banks that separate investment banking from sales and trading and research for the same purpose. It is well understood that trading on private or inside information is toxic to the market, it erodes market liquidity, and therefore various legal safeguards are put in place to limit this type of activity. We do not rely on the markets to fully reflect inside information in prices. The following table, based on a 1992 study in the Journal of Finance, examines performance of insider traders. The data here comes from the criminal cases where insider trading has been documented, and therefore we know exactly when insiders were trading on privileged information, what types of announcements they were using, and what kind of performance they were able to achieve. The most common example is trading on the takeover-related information. What we see is that abnormal performance of insiders is highly economically significant and statistically significant. Average cumulative abnormal return following a takeover-related news is close to 30%. These results confirm what most academics and practitioners believe, that trading on inside information can be profitable, and that markets are not transform efficient. This is the reason why insider trading is heavily regulated, and various legal restrictions are placed trying to prevent this type of activity in financial markets. Another way of looking at insider trading, rather than examining individual cases, is to look at the average price behavior around the announcements. The following study from 1981 looks at the price behavior and trading volume around the takeover announcements. What we see here is intriguing. Following the announcement, on average, there is no price drift up or down, which would seem to be consistent with the semi-strong form of market efficiency. What is puzzling here is that prior to the announcement, there seems to be a clear pattern in the price behavior. The price of the target stock tends to rise in the days preceding the news. It is difficult to explain this kind of pattern other than by appealing to the fact that some of the traders with privileged information are trading before the news, and their trades are getting impacted into prices and are moving the price of the target firm. On average, roughly half of the price increase that occurs as a result of a takeover announcement happens in the days preceding the announcement, which is strong evidence for some kind of insider trading ahead of the announcement. We might not know who exactly is trading ahead of the announcement. These are not the firm insiders who would have to file a note with the SEC following their trades, revealing their trading activity, but it does appear that some third parties with the sensitive information about the takeover are trading ahead of the announcement. We now looked at various types of information related to the weak, semi-strong, and the strong form of market efficiency. The conclusion is that markets appear to be fairly efficient in a weak sense. It is difficult to achieve abnormal performance using historical information on prices. Markets also pretty close to being semi-strong form efficient. It is hard to achieve abnormal performance based on public information, but there is evidence that private inside information could be used to achieve abnormal performance. Let's discuss a few questions related to these observations. One central question is, how exactly does information get into prices? Our example of the Challenger crash gives us a clue. Prices reflect information because various traders act on the information that they have. Markets don't happen to be efficient on their own. They become efficient as a result of the trading activity, as a result of various market participants pursuing profitable trading opportunities. By doing that, they help make prices efficient. They impound the information into the prices. Having said that, if prices end up reflecting all available information, who has the incentive to collect information in the first place if information gathering is costly? This creates a bit of a paradox. In order for the markets to be informationally efficient, someone needs to collect information and trade on it. Yet, if markets are as efficient as we say, there is no incentive to collect information and incur the cost. This suggests a relatively nuanced view of market efficiency. Markets don't happen to be perfectly efficient. What we see is a process by which markets are moving towards efficiency. This process, however, relies on a constant information gathering and trading by market participants. They need to be incentivized to do that, which means that there has to be some room for achieving profitable investment performance by investing in information gathering and processing. What has to be the case, however, is that after accounting for the costs of gathering information, there is no remaining room for abnormal performance as a result of intense competition between various traders. In other words, one cannot expect to achieve abnormal performance for free by looking at the easily available pieces of information. There may, however, be room for beating benchmarks, beating indices on a risk-adjusted basis by the amount that reflects the amount of resources expended on collecting and processing information. A few practical issues about the efficient market hypothesis remain. One is misidentification. Perhaps the reason why we see some evidence of abnormal performance is that we have missing risk factors. Our risk adjustment is not perfect. The possibility that some risk factors are missing from our risk model is always present, and this is something that we have to keep in mind when we examine evidence on performance of various trading strategies. A related issue is time variation in risk loadings and risk premia. As we identify normal and abnormal returns, we have to keep in mind that risk and risk premia may be time varying, and using risk models with constant risk premia, with constant risk loadings, can lead to misidentification of what we call normal or risk-based returns. There is a host of other issues that we can broadly describe as market imperfections. When we examine performance of trading strategies using historical backtests, we have to worry about frictions like transaction costs, liquidity, taxes, price impact, and so forth. In other words, when we look at the historical performance of trading strategies on paper, we have to keep in mind that these may not translate one-to-one to the actual investment performance in real market scenarios. Finally, we want to address the issue of micro versus macro efficiency. Our argument for market efficiency has to do with absence of arbitrage. It has to do with the fact that in a competitive market, investors pursue profitable trading opportunities and they eliminate mispricing as a result. This argument works best at a micro level. When we compare one stock to another with similar risk exposures, or one derivative security to another or to the underlying asset, we can expect arbitrage activity to eliminate mispricing. This argument is a lot harder to make at the level of broad asset classes, at the macro level. As a result, market efficiency as a concept has most clear implications for the micro efficiency, for the relative pricing of individual assets. It is a lot harder to think about abnormal performance at the level of broad asset classes like equities and bonds, real estate, and so forth. The main lessons from the efficient market hypothesis are the following. We can trust market prices. When we buy and sell financial assets at the market prices, we achieve zero net present value. Market prices are fair. We neither make abnormal returns, nor do we lose money when we trade at market prices. This has important implications in corporate finance, in capital budgeting. Market efficiency implies that market prices provide the best estimate of the economic value of projects, and that we should use the net present value, the market value of the investment projects, as our guide for investment decisions. Firms should also expect to gain fair value for the securities that they issue. When they finance projects by issuing debt and equity, they would expect investors to pay the fair price, because on average, assets that trade in the financial market are neither overvalued or undervalued. Market efficiency also means that we can read into prices. We could use financial prices to extract information about fundamentals. And this is something that can be definitely useful for forecasting and economic policy. Another lesson from market efficiency is that there are no financial illusions. Market prices reflect fundamental information properly. This means that the market value of the firm, the market value of an asset, is based on its payoff. It is not easy to trick the market, for instance, by playing with accounting data. The last conclusion, the last lesson for market efficiency is that one needs to have some kind of economic edge in order to generate a positive NPV. Otherwise, if you trade in the financial markets, every transaction is a fair transaction. It has zero net present value. In order to create a project which adds value, which has a positive net present value, we need to either have superior information or superior technology or access to cheap resources, some kind of competitive advantage, or economic edge that translates into a positive net present value. We cannot simply add value by buying and selling financial securities.